It's impossible for your portfolio to fall this much. Impossible. Statistics says it can't happen. On September 29th, 2008, a 7% decline in the Dow, 777 points to be precise, wiped off $1.6 trillion of American market value, $5 trillion worldwide in just a few hours. The odds of this happening were about 1 in a billion, and yet it did happen. Financial turbulence is not rare. It's at the heart of our markets. All right, so let's check this. 4th, 1998. All right, so back then it was 2008. You remember that, 2008. August 4th, 10 years previous. The Dow fell 3.5%. 3 weeks later, as news from Moscow worsened, they fell again by 4.4%. And then again on August 31st by 6.8%. Other markets reeled too. Bank bonds plummeted a third from their bank bonds fell a third. The hammer blows were shocking and for many investors inexplicable. It was a panic, irrational and unpredictable. The culmination of a meltdown, said one Wall Street Journal analyst. It might take a lifetime for investors to ever recoup their losses. And this is where I want to challenge you some here, man. Hang tight for just a second, though. Because this is where people say it always comes back. And I find that to be foolhardy. So anyway, August 1998 should never have happened. It was, according to the standard models of the financial industry, so improbable a sequence of events as to basically have been impossible. The standard theories, as taught in business schools and all these other places, estimate the odds of that final August 31st collapse at nearly 1 in 20 million, an event that if you traded daily for nearly 100,000 years, you would not expect to see one time, and yet it did. The odds of getting 3 such declines in August were about 1 in 500 billion. Surely August had been supremely bad luck, a freak accident, an act of God. No one could have ever predicted. Yet, a year earlier, the Dow had fallen 7.7%. Again, this is a year earlier than that was at 1997. Let's see here. That's a 1 in 50 billion probability. In July 2002, the index recorded 3 steep falls within 7 trading days, probability 1 in 4 trillion. And of course, on October 19th, 1987, the worst day of trading, it fell 29%. The probability of that happening, based on the standard reckoning of financial theorists, was 1 in 10 to the 50th. Odds so small they have no meaning, but it happens. All right, so what does that mean? But I just hung in there, Josh. It all came back. I want to share you something I got from Med Favors email. Med Favors, you got to sign for this guy because he just crushes. Big fan, long time. Relative size of the world stock markets. End of 1899, beginning of 2023. The UK was by far and away, well, I say, but yeah, pretty much by about a quarter of the entirety of the world stock market. Look at that. Look at that. Now it's 4.1. Japan wasn't on here. Now it's the second, I guess the second largest country specifically. But that is after a huge run up in the late 80s and 90s, early 90s. Germany, 13% there. Germany's 2% there because the U.S. has dominated everything. France, I mean, you can see this. The U.S. was an emerging market. And it just dumped. Now the U.S. is 60% of the entirety of the world stock market. And that's in 2023. That's after the decline we had last year. I mean, it's Russia. There's no Russia, right? No, because, I mean, basically, look, I mean, we know it. So when people say the markets always go up, look, now I want to point out something here real quick. Just because the UK is only 4.1% doesn't mean it went down. It just means the U.S. so dwarfed it. I mean, exponentially growing more so than the UK. This doesn't mean because it was 24%, now it's down 4.1, it's lost 80% of its value. What I'm trying to show you is that when people say the markets always come back, I'm like, do they? Japan didn't come back, especially while you're sitting there taking money out. You can't afford these downside losses, man. And it's one thing if the interest rates are at 1%, but now their interest rates aren't at 1. I'll just show you right here. Now, hold on a second. we'll see here right quick. Pause. Fed funds rate right there. Fed funds rate 4.45. I just sit there. I'm in awe at the people who think, oh, I'm down, 18% from a year ago. I'm like, dude, you're so far up from where you were 15 years ago, essentially. I literally don't understand how people can't take gains. So like, well, the markets always come back. I said, no, they don't. It never came back in Russia. It never came back in Venezuela. The UK has dwarfed what it was before. Again, that doesn't mean it's down, but just because you're witnessing history in the United States right here, this growth of you can't sit there and say that's going to happen again. It's just not, man. Let me show you something else here too. On my live stream last week, but I can't get over this. A U.S. population growth older. Let's look at this. The number of people aged 25 to 54, a group economists called prime age workers, inched up 40,000 in 2022. 40,000. Meanwhile, the number of Americans 65 and older jumped by 2 million. That continues the pattern. Since 2019, the prime age worker population has barely changed. Right there, in fact, it went down, went up 40,000. While the older people have grown up by, look at that, the prime age workforce, it was down, basically zeroed. But this grew up by 1.5. Well, that's 3 million. That's 5 million people. The older 65. The people aren't working. The people are drawing their assets down. So here you got a little bit of an upkick in 16 to 24. So that was somewhat offset this right here. But look at the 55 to 64-year-old people, man. There's no growth there at all. I mean, so this is not a growing economy, my friends. Stocks are contingent on growth. And this, I don't know what else to tell you. I mean, maybe these guys will give us a little bit of growth 35 years from now. But this right here is what we're dealing with, the baby boomers, for the next 20 years. And they're going to be spending their assets, living retirement, and using services on the back of these people right here. Then here comes, this is me, I'm at the 52. But and then this generation's coming in, and they're not growing at all. There is no growth. You need people to grow, and there is no growth. Well, China will rescue us. Are you freaking nuts? China is no longer the biggest country in the world. India is. Well, India will rescue us. Are you nuts? Look, I got no qualm with India, but India's thrown together a hodgepodge of different cultures, tribes, whole thing. That in of itself doesn't say, if we're relying on India or Indonesia, or what's the other one? We've got India, I think it's Indonesia, right? Where the growth is. Nigeria, I think it's Indonesia, but it's definitely India, Nigeria. I mean, look, dude, these aren't capital markets that we are going to, you're not, I just cannot stress this enough. If you're saying it always comes back, yes, because you're looking at it at this tiny section of time. You're not looking at the big picture. And I'm just telling you, dudes. I mean, I don't even know what his markets aren't even open yet. I don't care. This isn't growth. The only way there's going to be growth is through massive, massive technological advancements where you don't need labor anymore. You got to get a guy to put your friggin' shingles on, dude. You got to get a guy to do your plumbing. Those things are going to be expensive, and they're going to be scarce because there's not enough people to do that. And when those things are expensive and scarce, what does that mean? That means you're not going to have the money to buy other things, which the economy needs you to buy to grow, because personal consumption is 70% of GDP. And if you're spending your money over there, inherently you're not spending your money over there. And there used to be you could spend your money over there and over there at the same time. Those days are gone, dude. I don't know what else to tell you, man. If you're sitting there thinking I can deal with this decline that we saw in 1997, 1998, 2008, friggin' 1987. I mean, the list. And I remember when I was at Vanguard. I first started at Vanguard in August. I started on the phones in July. I'll never forget those times where it was like everything was falling apart in August. So I was like, whoa, it was nuts, dude. I was like, and I remember like it was yesterday. People panicked. Did they make it out? Well, the S&P 500 did. Did you specifically? Does the S&P 500 matter to you specifically? Not like that, but how much iterations of up and down, volatility, just pain, nervous, sleepless nights did you have to contend with? So you made it by 1998. Let's take a look at what the markets did in 1998, shall we? All right, so here's 1998. The S&P 500 was up 28.62% for the year. All right, I remember people freaking out, dudes, freaking out in August of 98 because the market was just getting killed. You looked up the thing, you could see the queue for calls. It was like 130 people in queue. Is nuts. I mean, I got massive amounts of overtime, by the way. I don't want to say it's fantastic because I hated that job. Because you couldn't make any recommendations to people like, wow, what do you? I was like, dude, we can't recommend what to do, man. We don't know your circumstance. Anyway, but you can see right there, the S&P 500 was up that year, and then the following year was up, and then right here, 1998, look at that. And then the next, 9, 12, 22, that doesn't, so this completely hides the down. And look at 87, by the way, is up. Anyway. But last year we're down 18%, Josh. Yeah, and guess what? If we look at Portfolio Visualizer, the total stock index from 2009 is at $10,000. At the end of February 2023, it's at $58,000. A compounded annual growth rate of 13%, dude. So check this out. I want to know where the growth is going to come from. All right, because we're not going to get it. Look, when I say growth, I'm not saying we're not going to get any. I'm just saying you're not going to get the 13. Look, anything can happen. If you're banking on that and you're about to retire, I think you're nuts. But hey, more power to you, especially if you're banking on that, you're about to retire and you're leveraged. Oh my goodness. Oh, that's just, I can't sleep like that, dude. That's all there is to it. I'm like, nope. If I can lock in 5%, I'm freaking locking in 5%. Anyway, so check this out. All right, so here's Sweden. The Swedish economy is collapsing due to an ongoing housing market crash. Bankruptcies in Sweden soared for the 7th consecutive month in February. A severe slump in Sweden's real estate sector has damaged the Nordic region's largest economy, which is struggling with consumer surging prices and growing interest rates. The country has been facing its worst housing price plunge in 3 decades, which has led to a reduction in investments in new dwellings. Interesting. The situation contributed to a surge of defaults in the country, according to the media outlet, this is Bloomberg, citing credit reference agency UC, the number of bankruptcies jumped by 11% year on year. Oh, that's no big deal. No. Capital controls come to the United States, and capital controls are in China now, where the money isn't falling, where it's welcome the most, as people say. Remember when everyone believed that USA was a free market economy that pushed for free trade around the world because it was mutually beneficial? Well, those days are over. According to the Wall Street Journal, Washington is planning to outlaw American investment in the high-tech sectors of rival economies. And I don't even have a problem with that. I got no problem with that at all. It's not growth for stocks, so I'll tell you that right now. Citing sources and reports from the U.S. Treasury Department and Commerce Department relating to the proposed regulation. Sources close to the formulation of the new regulation said the restrictions will primarily be aimed against China, and will likely focus on private and venture capital investments in the semiconductor, AI, and quantum computing sectors. The Wall Street Journal noted that the reports did not specifically name China, nor did they single out the specific sectors which are being identified as particularly a risk to the U.S. economic security. However, the reports indicated that the regulators will seek to target sectors which might increase the military capabilities of nations that rival the USA. So that's, the capital controls. Check this. Apple suppliers are racing to leave China. Wonder what that could be. So check this out. We'll keep going down here. Private equity has a whiff of Ponzi about it. Carlyle is having trouble getting its investors to take markdowns of the valuation of their stakes in the fund. And Blackstone defaulted on $530 million in commercial borrowing, even as their CEO received $1.28 billion in personal compensation. That's what a Ponzi scheme looked like. The investors get hit while the insiders make out. Where have we heard that before? Let's just end this here. Investor Mark Mobius says he cannot get his money out of China. Sucks to be you, Mark Mobius. I got no sympathy for you at all. You sold your soul to the devil, and this is what the devil does. The devil always wants his pay. And that's not saying China is the devil. That's saying you made a Faustian bargain. I'm just going to invest in China because I can net my profits. And China's like, yeah, okay, with slave labor. And now now the Chinese are saying, yeah, we're going to have some say in this. Anyway, so Mark Mobius says he cannot take his money out of China due to the country's capital controls, cautioning investors to be very, very careful about investing in an economy that's under tight government grip. All right, so remember everyone's like, oh, China's going to come to that'll be the next booming economy for stocks. Yeah, really? Is that true there, guy? Apple's fleeing. We're putting capital controls on China. They're putting capital controls on us. It's a freaking war that's coming, dude. How do you not see this? It's I have an account with HSBC in Shanghai. I can't take my money out. The government is restricting flow out of the country. I can't get an explanation why they're doing it because they're saying, yeah, you took advantage of us. Now that we're doing the same to you, baby. Mobius's comments were circulated on Chinese social media, WeChat. He led emerging market investment in Franklin Templeton for the 3 decades and is known for his bullish view on China. Now he's said to be very careful about the country. All right, so where are you going to go then? You're going to go to India? Okay, that's fine. You're going to go to Nigeria? That's fine. I got no qualm with that. But if you expect the markets to perform in those countries the way they did in the U.S. in the 20th century, you're freaking nuts. You're nuts. We had a constitution dedicated to free markets. It's not truly free. I get all that. I get it. But it's more so endowed in our constitution than anything else that these other countries do. It's just a fact. The days of this are gone. Again, you can invest in the U.S. The capital markets in the U.S. aren't going anywhere. They're just going to have less earnings growth, significantly less earnings growth, and thus the contraction on the valuations on the price to earnings. You have, so remember this, PE. All right, let's draw this out. The 1,000th time, PE, price over earnings. That's what PE ratio is, price over earnings. All right, so if earnings drop and the price stays flat, earnings drop, the price stays flat, what happens to PE ratio? It goes up. People get nervous about nosebleed PE ratio. So what happens if the earnings drop and the price stays flat? What happens to the PE ratio? It goes up. And what do people do? Is they buy more? Especially when I have a counter fund that's paying 4.5% on a short-term treasury, the treasury bond, the treasury federal funds rate, or do they sell to make the price go down? You want to take a wild guess, friends? Earnings drops, price is going to drop because people don't want to have a stock with higher and higher valuations. If you're not prepared for this, I got nothing for you, man. Does that mean you sell everything? No, of course not. I'd be taking gains like freaking yesterday. I got something coming out here. I got hear noise out here. 1 second. Oh, some guy. All right. But so what I do is I actually take some gains, and I locked in that 6% Federal Home Loan Bank bond I told you about a couple weeks ago, and I'm still contributing. My contributions are still going to VTI. But I've locked in a lot of gains, dudes. Lots of gains. Because I don't want to be anywhere near getting smoked on the downside. If war comes, capital controls comes, just older population. And like we just talked about at the beginning. I'll put this book in the show notes if you want to read it. You should. Man. You got more thick skin than I do. If you're sitting there thinking, I'm just going to let it go because it always comes back. I don't get it. All right. Love your thoughts. We'll see you.